Zachary Zink here, Mountain State Financial Group. I want to take a moment to address something that's circulating through the news media lately, and it has to do with rate adjustments for borrowers with good credit. The Federal Housing Finance Agency, which oversees Fannie and Freddie, has changed the loan level pricing adjustments on conventional loans. A loan level pricing adjustment is an adjustment to rates across the board for all conventional loans, the purpose of which was of raising prices on riskier borrowers without putting an unnecessary penalty on safer ones. This year what they've done is they've kind of revamped the whole table in an interesting way, and I think that the best thing to do would just be to show you a before and after. So here is what the loan level pricing adjustment for a purchase used to be. Your credit goes down, the adjustment goes up. As your loan to value goes up, the adjustment goes up, right? People with lower credit scores and less equity would pay a higher rate, just as you would think. So now let's take a look at the new loan level pricing adjustment so you can see the difference. In this new one, there's some interesting things happening. The bucket that most people fall into, which is credit scores between 680 and 740. The penalty for those scores has decreased significantly, particularly at the 80% loan to value range, right? Which is honestly where most people are. They want to avoid mortgage insurance, they put 20% down, and that's where you stand. A lot of people, and I would say the majority of people, fit into this bucket, people with 20% down and good credit. The benefits for the conventional lending are essentially people under 680. Historically, that's where FHA would usually kick in, and you'd start looking at FHA, which isn't nearly as credit sensitive. Now, FHA recently reduced their mortgage insurance premiums to make them more competitive. The point is, though, there was an option for people with these credit scores, and that was FHA. Other things that are interesting. The pricing adjustment actually decreases for higher loan to values. You know, I understand why, because as you go up in higher loan to values, what you're going to end up with is higher mortgage insurance premiums. But it's still interesting on the loan side to penalize borrowers for putting more money down. And finally, my concern with this whole thing, prior to this loan level of pricing adjustment, essentially anyone with a 740 or plus or better credit score was getting your best rate. That's not the case anymore. In fact, the adjustments are quite severe. My problem with that is there is usually very little difference in how a person manages their credit between a 740 and a 780 or a 720 and a 780. These are people who pay their bills on time. Where you're going to see differences might be how much credit they utilize or don't utilize. The nuances of getting between that 740 and a 780 are very minute. This one's a little hard to stomach, and I think that's why it's getting so much attention. But that being said, it is what it is. It's across the board. It's already in place, meaning this is already baked into the interest rates. And we'll see if there's more changes to come. So that's my 2 cents. If you have any questions, please give me a call. Zachary Zink, Mountain State Financial Group. Thanks.